Welcome to the session on country risk analysis. This is a version of the slides on this topic. It may not be exactly the slides before you, but it covers the issues in this topic. The first couple of slides that we have are examples of what can happen in a crisis. Have a read of this and you will notice that we're talking about a market, a stock market that fell by 7.6% in the previous week, and the monthly fall was 14%. So this is a drastic fall in the stock market. Any investments the multinational company has in such a market would fall dramatically. And this is not the first time that Russia has experienced such difficulties. Famously, a hedge fund, the largest hedge fund in the world at the time, Long-Term Capital Management, LTCM, you can Google it, they invested in Russia and there was a Russian stock market collapse and they got caught. So even the most sophisticated of funds, and they had 2 Nobel Prize winners on the board, can make these mistakes and get caught up by a crisis. A very interesting one from the financial point of view was the Argentinian crisis, where they had pegged themselves to the dollar, and as you can see there, it meant that their exports became overpriced and resulted in current account deficits and the need to borrow money in order to finance the deficit, essentially creating a surplus on the financial account in order to finance a deficit on the current account. And that is something that America has been practicing for a long time, but America's position in the world is very different from that of Argentina. And this started to create a loss of confidence in the ability of the economy to work this way, and eventually they unpegged the peso from the dollar. And of course this is relevant for the European Union, where a number of countries certainly France is thinking of leaving the Eurozone. And I think Greece is also been mentioned in the same bracket. Well, the example of Argentina is rather sobering, and you can see that we have the peso, it's the currency it went back to, had a 29% devaluation. And they converted all the dollars into pesos, so anyone borrowing in dollars suddenly found that their income was now in pesos that had devalued by 29%, and so that meant that the debt denominated in dollars then became very difficult to pay off. So these crises are very dramatic and have a profound influence in the economy. This is a list of world debt crises, and you're welcome to Google these and find out a little bit more about them. Third world debt crisis we're going to say a little bit more about, and the other one that I would pick out is the world financial crisis that gets talked about a lot, and the famous comment by the Queen when opening a building in the City of London, the financial centre, remarked about the crisis. This was during the crisis, and she remarked, well, why didn't anyone predict it? And that is the problem that we address at the bottom of the slide here. Normally when we are trying to predict the future, we conceive of it as this diagram on the right hand side. A normal distribution with outcomes that are graduated from low to high in a very even manner. And our normal distribution tells us that our expectation is at the highest point, and as we go to higher outcomes or lower outcomes, so the probability gradually declines till we get to unrealistically high and unrealistically low, where the probability becomes minimal. That is all nice and even, and is the subject of very much sophisticated statistical analysis. However, if we look at the probability of a crisis, we get a rather different picture here, an on-off. If we try and take an average of this, then we end up in no man's land between the two, and that makes measurement very difficult because it either happens or it doesn't happen. So our understanding of a crisis, our ability to measure it, is not one that we can apply our normal statistical models to. But before we look at how that is analysed, let's firstly have a look at the basic understanding of a crisis. If we look at the credit abroad, we can think of a multinational company investing in a subsidiary, going into partnership would be better, with a company abroad, getting involved in a foreign supplier, lending them money, this sort of thing. And this creates two sorts of risk. First one is commercial risk of non-payment that would be applied to any company operating either nationally or internationally. There is always the risk that if you lend money, it's not going to be repaid. Now, where it's a case of a developing country, often that lending will be backed up by a government guarantee, so that if the company fails, the investor will still get their money back via the government. However, if there is a national country risk crisis, then that guarantee fails, along with all the promises the government has made to repay bonds, its own form of borrowing. The forms of non-payment are also graduated in this way. We can have outright non-payment. This is where the country says we're not going to pay the debts, not now, not ever, and an example of that would be China and Russia after the communist revolutions, where they just saw it as a capitalist instrument of oppression and just tore up the bonds. Of course, when they sought to rejoin the world economy, they had these bills outstanding and they were asked to repay them, and some arrangement was made and there was limited repayment. So outright repudiation, that is very rare, but it does happen. Rescheduling, just like anyone who can't pay their debts, can I pay a little less? I can't afford these repayment terms. Can I pay less for a longer period? So that's one form, another form of non-payment. Moratorium, give me a break, as it says. Non-payment for the next year whilst we recover, and then we will start to make payments. And then the final one is what's called a haircut, which Greece was involved in. We can't pay all of the debt, but we will pay 70% of the debt, and then perhaps ask the home country government to make up the difference. So those are the four forms of non-payment that countries get involved in. By far the most common is rescheduling and moratorium. Here we have a quick reminder of the relationship between a developed country and a developing country in terms of the investment relationship. And remember that it's the multinational company investing abroad that creates the liability, the vulnerability that multinationals have when engaging in international trade. We see the exports here. I've grouped all countries, classified them all as either developed or developing, so that we would get this kind of balance if they all added up. Of course they don't, but they should do. If they all added up, then the exports of all the developed countries combined would be the imports of the developing countries, and similarly the exports of the developing countries would be the imports of the developed countries. Now, a developed country is able to export both goods through its extra productivity, and it should also, through its extra savings, be able to make investments. So on the financial account, we have investment in developing countries, and that is negative because it's a demand for foreign currency in a similar fashion to an import. And here we have borrowing from developed countries, and then a limited amount of capital repayment here. So if we have this arrangement, we can see that the developed country balances and the developing country also balances. If we look at how it does happen, we can see, I suppose you'd have to say this is, this is the other picture. We can see that it doesn't really happen like this. What we have here is, if we call China the developing country and the US the developed country, we see that on the current account between the United States and China, the developing country has a massive surplus, whereas we were talking about it having a deficit on the current account. It doesn't. It has a massive surplus with the United States, and the developed country, far from having a massive surplus, as there, it in fact has a deficit. So the opposite picture happens in reality. And this is looking at the similar picture with other countries. So if we go back to this picture, we can see that in fact what is happening is that there is a surplus on here and a deficit here, and borrowing by developed countries and from the developing countries. So we have the position where China invests in US treasury bills and invests its surplus from the current account on the balance of payments. So this is all to make the point that there is a lot of international lending arising out of the balance of payments, and it is not always developed countries investing in developing countries, but also developing countries investing in developed countries. So that is a kind of extra vulnerability, because if the Chinese economy, a developing economy, were to collapse in any way, then that would create problems for the developed country, in this case the United States. So the vulnerability to debt crises is not only a problem for developing countries as borrowers, but also a problem for developed countries as borrowers. Just to reinforce that point, we have the major advanced economies here, their borrowing going up, whereas actually the developing countries, their borrowing level as governments have been going down. So you can see that really from 2000, one can see that there has been a problem of borrowing for developed countries, and so the notion of a crisis hitting the developed world, as it did in 2007-8, was in many ways very predictable now that we have the benefit of hindsight. And this just abstracts that relationship. The major advanced economies their borrowing levels, gross debt as a percentage of their earnings, that percentage going up. So it's a bit like your own borrowing from the bank as a percentage of your income. You can see that going up. You can see it going up in the euro area, and the emerging and developing countries borrowing going down. So this vulnerability to financial crises is to be expected the world over. And this just restates what we've been saying, that how it should work, that surplus savings should go to developing countries who have no savings, surplus production should go to developing countries. But in fact, it tends to work the other way, and developing countries, their production goes to the developed country, and the savings that they get from that again is invested in the developed country. So it's a reverse of the traditional position. The last time it was like this would be perhaps, well, certainly it was before the First World War. In days of empire, this was the relationship. So we could call this the empire model, if you like, and the position we've just been looking at is kind of the post-empire model. And the players in this are the IMF and the World Bank, managing the international investment transactions. And one might say, well, why didn't the IMF manage to predict these crises? And this is the problem that we're now going to have a look at. I'm taking as an example the Third World Debt Crisis because that was very well reviewed and analysed. And there are basically three methods of looking and analysing the crisis. Market methods, that's looking at what the markets gauge as the risk, and remember that markets add a risk premium. So market-based methods, bank methods, and finally statistical methods. So we've got these three methods. If we look at the market methods for the Third World Debt Crisis, it looked at the borrowing rates of various countries, and it looked at the margin over LIBOR. LIBOR is the London Interbank Offered Rate across the world's currencies, and it's the rate at which banks lend money to each other. And for Mexico, for example, it would be the rate for the Mexican peso. In the ranking of 66 countries, Mexico was ranked 28th in the risk league, as it were, so number one being the highest risk country. And yet Mexico was the country that started the Third World Debt Crisis. I think it was 1982. It was certainly the early 1980s. They started the Third World Debt Crisis, which then spread across South America, all the South American countries, and then across Africa, country after country saying that it would not repay. So it didn't work particularly well. Another way of doing it is to ask investors for their subjective opinions through, as it says there, confidential email emails, confidential submissions by investors on their own personal rating of the risk of various countries. And again, Mexico reflected only an average mid-ranking risk. In fact, Mexico was an oil-producing country. So as with all these crises, at the time, they are very, very unexpected. So market methods really don't anticipate crises well at all. Another approach, detailed by Sheila Heffernan in her book on the Third World Debt Crisis, looking at various factors, non-economic factors, economic factors, and this is all put into a spreadsheet, and the bank looks at the details. I've not listed them out here, but the non-economic factors are going to be to do with political unrest, would be a major one, elections, any form of social riots, any form of social disruption. Economic factors are going to be exports, imports, GDP growth, inflation, value of the currency. So general economic factors. And for the multinational companies, they will also have a similar sort of approach, but they will also, in addition to that, and banks will as well have what we call a resident economist, somebody to analyze the figures and come up with their expert opinion. We'll have a look at the risk factors in a moment. The other element of is the country evaluation, and that is combining the risk factors and the economic subjective judgments to come up with an overall evaluation. And that is a subjective process. Looking at the risk analysis, the variables used, we have, similar to the bankruptcy model, which some of you may be familiar with, we have the process of Z-scores and logit analysis, which transforms the X's. What this does is that it takes the X and then kind of distorts the scale such that, as far as possible, if the Z-score is above a certain level, that means that the country will reschedule, and if it's below a certain level, it will not reschedule. So it's a kind of critical score, and you can see the relationship with bankruptcy, because essentially it's the same problem, only writ large for a country. So what are these X scores, these risk factors? Well, the most popular ones here are debt service ratio, and that is the debt repayment, the interest payments on loans by countries as a percentage of their ability to repay, which can be defined in various ways: tax revenues, GDP, things like that. So the debt service ratio is one measure that we have, and similar to that of a business, where the debt service ratio would be interest payments divided by income. Okay, so it wouldn't be GDP, because the government doesn't earn the GDP, but certainly it would be things such as their tax take. Then we have imports divided by GDP, the ability of the economy to pay for imports, growth rate of exports, current account deficit divided by exports. Exports is the earning power, current account deficit is the earning power of foreign currency, current account deficit is the net payment of foreign currency. So again, it's an ability to repay, not too dissimilar from the debt service ratio. External debt over debt repayments is looking at the level of debt that it is incurring and how quickly it's being paid off. The per capita income, the distribution of wealth throughout the economy, is also taken as a factor. Some of these factors are going to be well related, some not so well related. One suspects that the per capita income is perhaps not one of the strongest relationships. And then the percentage of national income invested, and that is what savings does the country have to repay these debts. If it had to liquidate its savings, how would that work in terms of repaying the debt? So various measures such as that, nothing that is overwhelmingly the best in terms of theory. It's all practical measures centered around the level of debt that is incurred in relation to the economy. Obviously it's going to be bigger for larger countries, etc., and the ability to repay. And this is a common problem in any form of lending. It's just that in this case it's related to a country. As we were saying, the Z-score is one where one might have a particular score, and if it's above that level, the country will almost certainly reschedule. There could be a grey area in between, and below that level, the country will almost certainly not reschedule. Now, there have been a number of papers looking at that problem, and the problem of prediction in this way, and this is the way that statistics tries to manage the distribution problem that we were talking about earlier. So if we just quickly flip back to that one where we're looking at the distribution here, the Z-score tries to create a number such that if it's, say, below that number, it's almost certainly going to be an outcome like that. If it's above the number, it's almost certainly going to be an outcome like that, where this is non-rescheduling and this is rescheduling. That's the methodology, but clearly there's likely to be a grey area. Now, just getting back to where we were, one can shift this Z-score up and down, and you can create two types of error, and you may want to eliminate one type of error in favour of another. And this is a very important slide for country risk analysis. If you're writing an essay on country risk analysis, you do really need to understand this. What we have is what are called type 1 and type 2 errors. I believe someone said I got them the wrong way round. It really doesn't matter, but check up. I'm pretty sure somebody said it was that way round. Anyway, they're what's called the off-lead diagonal outcomes. So let's have a look at a successful model would predict rescheduling, and it actually reschedules, or it predicts non-rescheduling and it doesn't reschedule. So that's what you want. However, these predictions can go wrong, and you can predict a reschedule and it actually does not reschedule. So that's one type of error. Now, for a multinational company, what would be the consequences of that? Well, it wouldn't have invested, and so what we have here is a lost opportunity. Which is a loss, but it's not one that goes down in the profit and loss account. Here we have that you predict that it's not going to reschedule, and it actually does reschedule, so lost investments, and there you do lose out. So that is a loss that goes down into the profit and loss account. So we could set our Z-score critical level such that it predicts almost all countries as rescheduling, except for a very few, say the United States, Great Britain, France, Germany, right? We predicted they're not going to reschedule, and everyone else is going to reschedule. Then we would have a lot of lost opportunities. But we would not have very many lost investments. On the other hand, we could go in the other direction and only predict rescheduling for a very few high-risk countries, and therefore we would be taking on a lot of opportunities, but at the same, so we wouldn't have many type 1 errors, but we would be incurring a greater number of type 2 errors as we include countries that are of, say, medium risk, and so our profitability is, well, potentially going to be higher. It really depends on the ratio, I suppose, of the lost, or the profitability of the lost opportunities compared with the losses incurred by lost investments. This is a general problem in statistics, whether you are mining for gold and drilling everywhere, or just drilling in the most likely places, or whether it's somebody defending themselves in court. You can imprison an innocent person or release a guilty person. Two types of error. And so it is with country risk analysis and more generally all forms of lending. You can lend to a high-risk person and earn money from that, but you're taking a greater risk that that person is not going to repay. So it is a general problem, and in statistical terms, with the Z-score model, it is a matter of where you set your critical Z-score will depend on the level of type 1 and type 2 errors. Natural risk aversion would suggest that you would be pretty generous in your predictions of rescheduling in order to avoid lost investments. But then you would lose a lot of opportunities and potentially lose a lot of profit. Other firms in competition with you will take, if they start taking a greater risk, then some of those firms are going to be more profitable, the lucky ones, and they could then start to take over. So it is a more complicated picture where there can be herd factors, where countries, investment companies and multinationals start to do the same thing on the basis that if they don't, they will get left behind. And yes, some of those may crash, but the successful ones are going to outstrip you. So there are competition effects that to overlay the simple type 1 and type 2 model. there's quite a lot to explain and discuss in relation to this slide. There have, of course, been many commentaries on country risk analysis trying to identify the causes, and here we have a list of causes. So some will argue that liberal capital markets, the free movement of investments, has meant that investment companies taking on greater risks, and the consequences, as in LTCM that we talked about earlier, means that crises are more likely to develop. Others have looked at the large inequalities globalization and its discontents is a title that is common in international finance, where they see that the very large differences in earnings in particular means that investments are going to flow to low wage level countries, and this creates instability in the markets, instability in the developing countries, and again increases the possibility of a debt crisis. Corruption is a major problem, and there are corruption indexes, and generally the misappropriation of funds. The problem of monitoring is an IMF problem. We see the IMF figures, they're not necessarily reliable, and some countries have been accused of falsifying their figures. China, Greece, most recent ones. Then we have the issues of the failure of the IMF and the World Bank and the Group of Seven to really control investment in particular. Real investment is reasonably easy to track in terms of exports and imports. Portfolio investments, that's buying shares, is much more difficult to track because it will often go through tax havens such as the Isle of Man, the Bahamas, and so on, and so becomes difficult to trace. So there's generally a lack of control and a lack of agreement on a worldwide level as to how these transactions should be measured. Then we've concentrated a little bit more on the statistical issues involved in trying to assess the risk and trying to take the decision as to whether you think a country is too risky. Now, we mentioned earlier on that market methods was one of the factors, so this is quite, I suppose, getting quite old now, but I would imagine that the differences have not changed greatly. The bond market is lending to governments. Governments in return give you a bond, which is a promise to pay a certain amount regularly and a repayment of a large amount at the end of a specified period. So a 5% 10-year bond would be, if it's a UK bond, would be the payment of £5 every year, and at the end of 10 years a repayment of £100. So countries sell these promises, and the amount that are paid for these promises determines the effective interest rate on the payment. So these interest rates will differ depending on the risk involved in the lending, and you can see that Brazil comes out at this instance at a high risk, and then it gradually decreases as we go to safer and safer countries. So apparently Japan at this time was the safest, then Switzerland, and so on. So not a great deal of difference down here, but then it suddenly ranks up for these high-risk countries. And Greece indeed did not repay, and there have been haircuts since 2010. So banks in particular have lost out heavily through their buying up Greek government bonds. This is simply doing much the same thing in terms of numbers, interest rate, looking at adjusting for inflation, and the remainder is essentially risk premium. So you can see that for some countries the risk premium is very low, and we even have the phenomenon, this is 2013, of negative risk premium. Actually, the interest rate does not even compensate for inflation, and there have even been negative interest rates in Japan, for example, noted as being a very safe investment, and in 2013 you can see it's very low. So you may not get back your full £100 investment, but you will get a return, and in this case in yen, and so there is for a foreign investor there's a currency risk as well, and that's considered low. So these are the country risk ratings, Standard & Poor country risk ratings. So a country is being evaluated in much the same way as a multinational company, and you can see that certain countries are rated as high risk, and AAA countries such as the United Kingdom and Germany are considered very much safer. So that concludes our look at country risk analysis. There's a little bit of history there about the analysis. I've given you two straightforward ones, examples of crises. We had a little look at the Third World Debt crisis. We looked at market methods and statistical methods. And what was the other one? Ah, yes, bank and multinational company methods. So kind of within company methods, if you like. And then we looked a little bit more closely at the statistical models, in particular the Z-score. And then we saw the problem of taking a decision as to whether a country will reschedule or not, and that decision has implicitly to be taken, and the type 1 and type 2 error problem. And also we looked at investments across the world, how looking at the balance of payments, investments were from developing countries to developed countries, as well as from developed countries to developing countries. So the vulnerability to financial crises has is spread throughout the world, and it is now a very important topic for any multinational company investing in particular developing countries. Okay, so that concludes our session.